Title IV. In 2012, President Obama signed the American Jobs Act into law, which had 10 provisions to improve the working outlook and overall financial opportunities for Americans. Title IV of the Jobs Act, also referred to as Regulation A+, allows companies that want to raise between $3 million and $50 million to do so from anyone, regardless of assets and income levels. This particular portion of the Jobs Act was enacted in June of 2015 and it is still gaining momentum. Investing in companies in the test the waters (TM) phase is no longer just for the rich and already affluent. Any person in the world can invest their money in a company they believe in, and see the potential financial rewards of that investment. What is Title IV of the Jobs Act? Title IV allows startups and later-stage pre-IPO companies to use equity crowdfunding platforms to raise as much as $50 million from both accredited and non-accredited investors. Title IV is broken up into two tiers, Tier 1 and Tier 2. Tier 1 allows you to raise up to $20 million while Tier 2 allows you to raise up to $50 million. Check out the key differences between the two tiers below. Tier 1 raise up to $20 million. Anyone can invest worldwide. The company can publicly advertise financials required must satisfy blue sky laws in each U.S. state that investors live in. No limit on investment amount by Main Street investors. Tier 2 raise up to $50 million. Anyone can invest worldwide. The company can publicly advertise. No state registration required. Requires audited financials. Non-accredited investors are limited to 10% of income net worth per year. Tier 1 file a disclosure document and get the qualification from the SEC. Have your financials reviewed. Must register for blue sky laws in all states investors invest from. Tier 2 file a disclosure document and get the qualification from the SEC. Provide audited financials. Disclosure requirements, annual, semi-annual and current reports. What restrictions are there for non-accredited investors investing in Reg A+ deals? For Tier 1, the investor has no restrictions on the amount they invest. For Tier 2, non-accredited investors have caps on how much they can invest. They can invest a maximum of 10% of their annual income, net worth per year, depending on which is greater. Big changes for the crowdfunding industry. The implementation of Title III will skyrocket the number of available investors in the U.S. from 3.4 to over 233.7, with an estimated combined net worth of over $50 trillion. One of the biggest implications of Title III is the leveling effect it will have on the fundraising landscape. Individuals will have more opportunity to invest or solicit early-stage funds, regardless of their personal wealth of network of potential investors. We'll start to see a shifting of capital from the venture capital market, which is estimated at $30 billion, to the critical mass of non-accredited investors. For the first time in 80 years, millions of Americans will be allowed to invest in early-stage companies, bringing to bear a collective buying power that could balloon the investment market to as much as $300 billion.